Hey people, how's it going? Thanks for joining, liking, subscribing, and choosing us for a discussion piece. Anyway, so what's happening? Well, Canada's top finance experts see the Bank of Canada aggressively hiking rates. I was ridiculed, made fun of, trashed for saying that 3 years ago, 4 years ago, 2 years ago, a year ago. Why? Well, I understood that inflation was running rampant and they were using the cover of, oh, the price of oil, oh, we're going to war, oh, they pulled the trigger on something, oh, they did this and they did that. Fair enough. So they were using the cover of hiding inflation very well. Well, it's gotten to a point where it's double-digit inflation. Housing in English-speaking countries and the blue states in America were already in double-digit inflation back in 2016 onward. Into really dangerous territory. Let's go to the channel time machine and see what we've been talking about. Look at this. 5 years ago, get out of Vancouver, price hikes for 2017. Mass exodus. It's getting expensive to operate a normal day-to-day, normal, basic lifestyle. Housing is massively overvalued in 2016. It looks grim. That's from 5 years ago. What else do we got here? Vancouver approved 7% property tax rate. So look at the gap. It's getting expensive to live there, but they already approve a increase in property tax. Australia must raise rates in the next month. That was 3 years ago because they were going into severe inflationary levels, which we covered here on the channel. And again, something not too old ago, Bank of Canada will raise rates. That's 500% this year to start within weeks. So that's 0.5 basis points, right? And we were, look at this, $42 billion in interest to service their mortgages in Canada 3 years ago. And it's no secret that Canadians have been taking out a buttload of debt. And this is when they were trying to go with negative interest rates for people that saved money. And yeah, they've been forecasting interest rate hikes for the longest time, but they've held back. And it goes on to this, ring the alarm, rates are going up very, very fast 2 years ago. And net worth rising, but higher debt stings. And it goes on and on, massive condo oversupply, rising interest rates this October, 4 years ago. So they were trying really hard to tame inflation way back, but housing was just becoming more and more unaffordable for the middle class. The middle class is finished now in Canada. We have a very big disappearing middle class here in Canada, so that's something we covered on Trends in the Housing Market many times years ago. And it's taken to effect that it's impoverished and forced many Canadians into homelessness, believe it or not. It's gotten that bad. And we're talking about the educated, people with degrees, people that thought they were doing the right thing. Anyways, let's get to today's story. Enough with the time machine. So here it is. This is what we've been talking about for a long time. Canada's central bank is overwhelmingly expected to hike interest rates aggressively. We polled the country's top financial experts for their overnight rate forecast. Remember, before they pulled the trigger on the sickness that engulfed the earth, that they had to shut everything down, we were having overnight rates. Remember that with the repo markets? We were having banks not trusting each other. Remember that? Yeah. So nearly all expect Bank of Canada to hike rates tomorrow. They don't see the rate hikes ending there, though. Over the next year, they see interest rates rising aggressively to curb inflation. Oh my God. So this goes into the sentiment index with the overnight rate. And then why not U.S. traditional interest rates forecast models? So it goes into saying market forecasts are mostly based on bond yields. Okay, we know this already if you've been watching the channel. Great quantitative data, but we've seen more emotional management of the economy. We expect objective management, but that only works if we're managed by algos. Since humans make the decisions, they make decisions that aren't objective. Now, we wouldn't be in this mess if the economies were left on autopilots. They're talking about algos here. They're 100% right. Autopilot. What do you mean autopilot, Mike? Well, when rates get to a certain point, it tapers. When inflation gets adjusted, or to curb inflation, that gets autopilot, just does everything automatically. Ooh, everything's getting too expensive. We need to raise rates to build confidence in our currency. And that's why we kept saying the great Canadian peso is coming. And that's from a video 4.5 years ago. It's coming. And it's going to hurt a lot of Canadians. And a lot of Canadians are going to wake up with a rude awakening. I took that from Ravishing Rick Rude, by the way, a few years back. But anyways, so here it is. This is a very important piece right here. The last Bank of Canada overnight announcement is just a great example. The market showed a census of rate hike for the January 26, 2022 meeting. However, the CORSI showed no experts had forecasted that rate hike. Some even forecast a hike at their institution, but didn't feel it when anonymized. Consequently, the index was one of the few indices to doubt the rate hike. It turns out it was right. Obviously, no tool is perfect for forecasting. We know that already. The one tool that they could have got out of their toolbox, and we discussed this, is raising rates. And we wouldn't be in this mess today. And we're not presenting this to that way either. We do think it's important tool that can be added to your arsenal to enhance forecasts. So there's the Bank of Canada expected to hike rates aggressively this year. So what does that mean? So if you have $1 million mortgage, the average home like now in major cities, if you go off the benchmark, you're going to be paying a lot more per month. Now, back in 2018, they were raising rates when Trump and the United States was slowly raising rates. Canada was following in suit. And there was a lot of Canadians that were really broken, and we covered this on Trends in the Housing Market very close. A lot of Canadians were broken to the fact that they couldn't afford the extra $200 a month because that will leave them insolvent. Back to the channel time machine. There you go. 46% of Canadians $200 or less away from financial insolvency. That was from 3 years ago. The number of Canadians who are $200 less away from financial insolvency at month end had jumped 46% from 40% the previous quarter. An interest rate rise according, look at that, 3 years ago. And this is very important that people understand. It's going to cost a lot more to exist. Now, a lot of the smart people have been heeding the warnings over the last 7, 8, 9, 10 years. I've been saying, get out of the major cities. Mike, there's no jobs. Well, there's no jobs now. Look at what happened and look how everything played a part. Everybody was played in this one. The ones that knew did well. The ones that followed may go to hell. That makes perfect sense. Anyways, let me know what you guys think in the comments below. Let me know what you guys feel about the situation that we're in, because more and more people are going to need more credit counseling, not more credit. And that is, I think, the future of tomorrow, a credit counselor. Let me know what you guys think. Mike Martin's here. Guys, don't forget to join me on Odyssey twice a week for Mike in the Night. And don't forget to follow our replays on Rumble if you like to watch Mike in the Night on your television. Thanks so much, guys. I'll see you on the flip side, and I have spoken.